Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Knightscope's 2022 Q1 results that were just released yesterday. I'm going to give my takeaways and my thoughts about the quarter. Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Knightscope, so this video should be for your entertainment purposes only, because I could be wrong about everything that I say in this video. You need to do your own research before making any investment decisions. So, real quick, I'm going to give you sort of the overall thoughts, and then I'm going to go into a little bit more detail. But if all you wanted the overall thoughts, here's the 30-second summary. I didn't really think there were too many surprises. Revenue is up a little bit. Sales backlog is flat. Gross margins are still quite negative, but better than Q3 or Q4. Trending upwards, you would say, or at least slightly better. Raw materials are up. Number of robots ready to be deployed, or at least robots on the balance sheet are up. OpEx also up across the board. They still, or I should say still, they have no debt, as I've sort of went through before, and they have roughly the same overall cash runway that should get them till roughly, I'd say, middle of 2023. Assuming no additional dilution or anything else. So that's the highlights. If all you care about is that. So going in a little more detail, let's look at just a little bit of their numbers. And so I actually have my own graphs here. I pulled all the numbers out of this, and let me get to where I want it to be. So first thing that matters, first thing everybody cares about, and that matters quite a lot for Knightscope, is their revenue per quarter. And this quarter was up. You can see right here, this is their last 3 quarters. Maybe I can make this slightly larger, just a tad bit. Maybe that helps. So this is their past 3 quarters. You can see it has been trending upwards here, kind of as we expected. I was a little, I actually had projected and thought the revenue might be slightly higher, but, upwards is good. It's hard to say exactly when they deployed each robot, when they sort of get to recognize the revenue. So, it's hard to say. I do, based on the other statements the company has made, I think they have even more robots deployed today. And so I kind of expect this to keep trending upwards. So we'll see. That is obviously good. And I talked about their margins, right? Their margins. Where's my graph for their margins? I think it might be over to the right. Oh, come on. I can't even find my own graphs. There we go. Gross margins per quarter. So we've actually seen this trending down throughout all of 2021, which was very bad, right? It's hard to tell, right? Are they actually getting worse? Are they just burning through more money as they deploy more robots? I've explained many times in the past why I do not think that is, although it is the case, that I think it's really not going to continue as they deploy more and more robots. And we saw the first inklings of that this quarter, right? Let me edit this graph real quick and see if I can get it to show the points, because that will maybe drive it home, so you can see which are the actual data points rather than just the line here connecting them. We saw this getting worse and worse and worse quarter over quarter, but we see the reversal of this of this series right here, where we see that their gross margins on a percentage basis were actually better. Still negative, right? Make no mistake about it, this is still nowhere near profitability. However, things are trending in the right direction, and I am hoping, I am expecting, even, let's say, not just hoping, based on what I fundamentally know about the company, and I could be wrong, but I believe that this is going to continue getting better if they are able to actually grow revenue and grow the number of robots have deployed, and retain the customers that they have and not have all the turnover costs. And not to mention, as they do get around to deploying the 5th generation K5, that's a whole nother topic. But that is, that's another big item that I think will help these gross margins a good chunk, if I understand correctly. So that is a big thing. I did mention that I'm not going to go over this today. Where is... That's revenue. So this is something I've looked at in the past, and this was my basis for actually thinking that their revenue was going to be up this quarter, right? And that is the number of robots that they have either on lease or available for lease. And this ignores all depreciation. So this should be sort of roughly a measure of the value of all the robots that they have, right? That are theirs. And this is a number that I would expect to be, as I've mentioned before, sort of a leading indicator for future revenue. We can see that this was up yet again this quarter. It was up to, what is the number? Let's see. On lease or available for lease. It was up to almost $7 million worth of robots. And granted, you have to subtract that a little bit for their demonstrations and such. Or no, sorry. This is with those subtracted out, right? Total, they have 8 million. This is about 7 million when you exclude the ones used for demonstration, R&D, etc. And so that, again, is a good sign to me that I think, at the end of March, they had even more than they had at the end of the year. And so you expect that those two sort of go into service soon, especially when you look at, and this gets me to my next thing I mentioned, is their sales backlog. We got a new update that as of May 2nd, and again, they don't report these with at the same time that the 10Q represents, they give some other date. That's historically what they have done, because previously we knew what their sales backlog was in March. Now we see what it is in May 2nd. It was 1.6 million, and it represented 29 robots. And so that, that 1.6 million of annual revenue that backlog represents tells me that they have, more robots, more clients lined up that they can deploy these robots to. And now that they have, that they're growing the number of robots, this is where I wanted to be, that they're growing the number of robots here that they have available to deploy. Those are going to get deployed. That's going to turn into revenue. And, we see the company growing. And I did this trick last time. This is what's on the thumbnail. I hope this isn't really, clickbait. It's not misleading, but I think this is really exciting to me that we see this ticking up even more. And again, this is ticking up in a pretty dramatic fashion. Doesn't look so much when it's scaled out like this, but let me find the graph. This is the same exact graph, except I chopped it off, sort of put a floor at 4.5 million rather than at 0. And so you can really see the change where for a good year, almost 2 years, year and a half, this was in roughly the same range. It went from, just slightly over 5 million, maybe like 5.1 to about 5.3, maybe, and it dipped down and went back up and it was improving. But now we've seen this going up quite a bit, right? It's going up by $500,000 per quarter in terms of the value of the robots that they have either leased or available to be leased. Again, ignoring depreciation. And so this, again, I think is a leading indicator of what we're going to see when they release their Q2 numbers. Like I hope, right? Crossing fingers. I think this, when you see that they have a lot more robots that they've been building and they are able to deploy, and you see that they have a sales backlog, they could deploy those robots to the customers, then, to me that strongly suggests we're going to see continued revenue growth. And this actually is a bit of an indication that we are likely seeing better retention than they've had in the past, right? Because I think you wouldn't see the number of robots that they own going up if some clients were canceling, and because they're going to basically take those robots and just redeploy them to another client, right? The fact that they're actually building more and more, and you saw that they weren't building more and more during this time, right? The number of robots they had for quite a while didn't didn't materially increase, but now it is. And so I think that's a very healthy and positive sign. And then you even see the number or the amounts of robots in progress, not finished, but robots in progress and raw materials, right? That's been ticking up even the past couple quarters. You see that trend continued here. I think that, the number of value of robots in progress, let me look at those actual numbers to see how much that increased here. That would be ASRs in progress, this row right here. And so we see it's higher than it was at the end of December. Not quite as high as it was at the end of September, but otherwise it looks like it's the highest value that's been so far. And obviously they have more raw materials than they ever have in the past. And again, I think this is a function of the COVID supply chain constraints that they've talked about. So they ordered larger quantities of raw materials. And so hopefully this is, again, a good sign that they're going to be able to build more and more robots with these materials. that they now have them on hand. That's my hope, that they've ordered these materials ahead of time, that they have lots on hand, so that this is no longer, at least in the short and medium term, a constraint for the company. So, just calling it out there, operating expenses were up across the board. We saw sales and marketing and G&A. Jay says, cool stuff. Thanks, Jay. So, we saw R&D expenses up, general administrative up, sales and marketing down for just on the quarter, but still up relative to pretty much any other quarter in the past. And they if you read the notes, there's a little bit that they do talk about these. They do talk about the R&D increase. You can find this. They talk about they are focused on it's increased due to personnel related costs and increased headcount. Obviously R&D. But they specifically call it out that they're focused on the K1 hemisphere, which is their smaller K1, just looks like a little circle thing that they can mount on a wall. The K5 5th generation, right? And I mentioned that I think that's going to be very important for the company, because they talk about how that helps reduce the cost of both assembling the robot up front, and then also the servicing of it over time. And they also called out their increased investment in Fedramp, which again, we know, or at least I have an expectation that is gating some business with the federal government. And so again, I've mentioned this many times, that I think that is a significant catalyst for the company. And so I'm happy that they are spending the money on these things. One thing that is conspicuously missing here is any mention of the K7, and given where the company's at, that seems like probably the right thing to do. I think they probably should focus on sort of building a profitable base to the company, or at least something closer to profitability than the K7, which probably is, again, hard to say, but I would guess years out from starting to generate enough profit to be worth the expenses they're putting into it. And clearly they should put some resources into it when they can, but when there are more pressing near-term opportunities, I'm actually happy that they're putting their resources into these efforts right here. They mentioned G&A, that would be probably just down here. I said G&A was up, and this is to be expected, and they call it out explicitly. There was increase in legal, corporate, and financial service expenses related to their public listing in 2022, right? And so I know that they did actually hire some more people, but I've looked at a couple different companies that when they actually went public, you saw that those expenses for that quarter ticked up quite a bit. And so it'll be interesting to see what G&A looks like in the next few quarters, to see if this comes down a little bit, just because because there may have been some one-time expenses sort of in Q4 and in Q1 specifically related to the listing. Let me pause. Let's see. Jay says, in the future, it would be interesting to analyze catalysts which could possibly create exponential growth similar to Tesla. Yeah, I have a little bit of thought on that. I had an older video talking about the catalyst, and I think most of those are still ring true for the company. But yeah, it's part of my thesis in Knightscope, right? Is that Knightscope is not just going to plod along and grow slowly, right? That there is a point where, like, I think it's a company that has a potential. I'm not going to say like Tesla. I think Tesla is, that's the gold standard of growth companies, right? Exponential growth is definitely the way that I would, obviously you would describe it that way. But I do think there are some interesting aspects. I'm not gonna get into that too much today. I'm gonna focus mostly on the Q1 results. But yes, I agree. I will try to touch on that in the future. Thank you for the suggestion, Jay. Appreciate it. Thanks for hopping on here. I love having comments on here. It makes my day. What I then wanted to get to and talk about was sales and marketing, and they did call this out again. I know I've talked about this. The sales and marketing expense, you can see, was super lumpy. Lumpy in the sense that it went up and then it went way down for a quarter, right? And then it went way up again, and now it's down slightly quarter over quarter, but still up from every previous quarter, and way higher still from Q3 of 2021. And they do give you a little bit of insight into here. And the increase was primarily due to increased investment in building our sales force, and a significant increase in commercial advertising expenses designed to increase public awareness of the company and its products to potential customers and investors. And then they also say, and there's personnel related costs. And I know that they've hired some sales force. That makes sense to me. They're obviously going to have some more sales and marketing costs as they're doing, as they're making more sales, right? I would expect that. However, this huge difference between the quarters, where we saw this quarter be so far down, and they've talked about in the past, and they even alluded to it here, and not quite as explicitly as they have in the past, but it's this advertising costs. And again, I've stated this in the past that I think this advertising is not necessarily advertising targeted at customers. It was advertising targeted at investors. And I think this is a cost, this is part of my hypothesis, is that after Q1, we will see the sales and marketing numbers look closer to this number down here, where it was, under $1 million. And I expect it to probably be around $1 million, maybe a bit above, but not in the $3 million range that we have seen, because I don't think they're going to be, doing the same level of advertising that they were when they were advertising to raise awareness with investors. We'll see. I could be totally wrong. And if their sales and marketing expenses continue being, $3 or $4 million per quarter, that is going to take a humongous bite out of the company. But they've made some comments to this effect. And they were, again, more explicit in the past in terms of what they spent that money on. And it was advertising, not necessarily sales. And so I again, it'll be interesting to see in Q2 if it proves out my hypothesis. Let's see. Not too much else to say. One other thing is that they had $21 million of cash on hand at the end of the quarter. And they also, if I can find it, said that they reaffirmed, where is it at? That's not it. Yes. The company has projected operating losses and negative cash flows of approximately $1.5 million per month for the next several months. And so they reaffirmed this. This was in their 2021 10K. It's in this report as well. Same number, $1.5 million per month. If you do the math, given the $21 million at the end of Q3, that puts you through to about May of 2023, right? With just their cash on hand right now. And that is, again, this is a clean balance sheet where they have no debt currently, right? All that debt, was a convertible debt that got converted. And so right now they have no debt. They have enough cash on hand with their estimated expenses to last through to May of 2023. So that to me was good. And then they have the standing agreement with B. Riley where they, B. Riley will purchase the stock from them. So, I think they have liquidity for quite a while. I don't think it's even though they are losing money, right? They are certainly not profitable. I think they are well capitalized, which is the takeaway here. Another thing that I did want to mention, because I think I missed it, that was increased cost. They did give just a little bit to talk about why did their cost of revenue go up, or what are the components, right? They actually talk about increasing year over year. On a percent basis, their gross margins, were less negative, so they improved from last quarter. But they do say, that it was attributed to production, shipping, and service of the robots. And they added this statement, which I haven't seen in the past, and they said the cost of revenue net is primarily related to the average service cost per machine and stock-based compensation. And they actually call out, I think somewhere else, where stock-based compensation for the quarter was only like $80,000, so it's not even significant. But this does underscore that a lot of that cost of their services, the cost that is not just the depreciation, is largely driven by how much it costs to service the machines. And so that, again, sort of does tie it back to what I said about, and what the company has said, really, about the 5th generation K5 hopefully being a, design that it has a lot of experience incorporated into it and should help reduce these service costs and therefore, sort of reduce their cost of revenue and improve those margins once they are able to get that deployed. So that is, I think, everything that I wanted to cover today. I see Let's see if Jay is still on. No, it does not look like Jay's still on. Although this app is not always accurate. I'm not sure if Jay's still there. If he has anything to say, I'll hang out just for a minute while I give the spiel to anybody else who's still here. That I do these videos live, usually around 10 or 11 p.m. Eastern U.S. time. I try to do videos. I do my videos. I don't do them on Friday evening or Saturday evening. I try to do one Sunday through Thursday evening, although, things don't happen always perfectly because, life gets in the way. Jay did say something. He said, I think uncertainty in market and Fed fears could be one of the reasons for the downward direction, as well as many customers might hold new contracts. Yeah, I think that's definitely, I think, just the correlation with the overall market and specifically, the tech and NASDAQ is definitely one of the reasons. And I've made this point before that, we all have $10 per share as sort of the anchor price in our mind, but that pricing was set in near the height of the NASDAQ in November of 2021, and so I think that a lot of that initial drop in February was sort of a delayed recognition of revaluing the company to where things were in February versus in November. And then, yes, I agree that a lot of the downward trend since then has been, sort of what you would expect for kind of a higher beta tech stock that's not profitable given, raising rates and the overall compression in multiples for tech companies. But I do agree that that's actually a concern going forward if we do move into more of a, let's say, overall fearful environment where people are not are putting off expenses that could be could lose out on some sales for them, right? That could be a reason. However, again, I actually think the macro factor of labor, right, the sort of the shortage in labor is a big deal there, and I think that's I was just thinking about this the other day, and I'm going to hop off after this because it's not really a fully formed thought. But I think if we end up having, sort of an economic slowdown due to the Fed and due to, just the general economic conditions, if we end up seeing labor, sort of some job losses or some, sort of not so much of a labor shortage anymore because let's say people aren't hiring as much and wages aren't increasing quite as quickly, that could actually be bad for Knightscope if there are more people available to do work, right? If there are more people available to do these security guard positions, that makes Knightscope slightly less attractive. Because I think that has been one of the macro factors that has helped Knightscope in recent history is, hey, we can't get the people to do the jobs, to fill the jobs, and so all of a sudden, maybe a robot is more attractive. So anyways, thank you for the comments. I appreciate it. I have to hop off today. Hopefully that was useful and informative today. So thank you for watching and have a good one.